Absolutely. Thanks, Ron. Great to be here. So banking as a service is the ability, we allow companies to build their own financial products, to say it simply. And those financial products can include payments, banking, debit cards, cross-border payments, credit. So anything that a bank can provide, it's giving tech companies and non-banks the ability to create their own versions of the traditional financial products that we all grew up in. And I think a key element of banking as a service in its future iterations is we give these companies APIs that power the core pieces of functionality like open an account, send money, receive money, make a transaction. And we give them the ability to create what the user experience is when doing one of those functions and adding it to a third-party ecosystem. So to kind of give a little bit of the history of it, and this should kind of illustrate what I mean, banking as a service really started with payments as a service, and the companies like Stripe and Braintree that gave developers the ability to embed payments into apps in new and innovative ways. So the kind of way that you hop out of an Uber and your bill is paid, that was an API that was being built into Uber's user experience to reimagine payments. You can imagine how much worse it would be if you had to go into a login page, add your name, your credit card number, your expiration date, click send, obviously not seamless. So payments as a service allowed us to really make that payments experience single click, no touch, whatever it is, and embed it into a third-party ecosystem that people are frankly obsessed with. And a payment is a big piece of that. The next kind of iteration of that came with banking and debit cards. So the whole slew of neobanks that have shown up like Chime and Acorns and Stash and Wealthfront.
And Varo.
Varo, of course, excuse me. But all those companies essentially were not banks to begin with. They accessed the infrastructure of a bank along with a bunch of different APIs and other kind of ancillary ecosystems to create a banking experience inside of their app and do something new and unique with it. And now what we're working on now at Railsbank is the next iteration of that, which is credit. So for all the companies that have built debit cards, how can you reimagine credit cards? And it takes a whole new realm of difficulty and complexity, but a whole new market that we can open up for innovation.
Great. Wesley, I wanted to get you into the discussion as well. Dov talked about, the need for challenger banks to utilize bank as a service type services. But you guys have gone down a bit of a different route, getting your own charter. What's your involvement now from a banking as a service perspective, and how have you seen it evolve as well?
So we, for one, just to tell everybody who might not know, so Varo Bank, we're a challenger bank. We've been around for about 5 years, and to Dov's point, we started out with a banking as a service model. Though using and this goes back to the history of the prepaid cards, right? A lot of the players in this space started out with prepaid cards back, 15 years or so, right? So we worked with the Bancorp Bank as our sponsor bank, and Galileo as our processor, right? And Galileo, they both work with Chime, et cetera. So we used this combination of a sponsor bank and a processor with APIs, just as Dov describes, to get to market quickly, right? And to build up a franchise and build up a business and learn. We, from the very beginning, had a view that we needed to eventually get our own charter to kind of sustain sort of our long-term sustainability and profitability as a business. Because when you're using a service provider, you're sharing your revenues, right? You're paying the service provider, right? And you're also limited in what you can do, right, to what those service providers offer, right? So at some point you hit enough scale, you want to grow enough, you basically want to grow up and kind of move to the model we think will make us successful in the long run, which is to have our own charter, control our own economics, control all of our own data, and also then to be able to offer a full suite of financial products without being dependent on a set of external partners to bring them to market.
So does that effectively get you out of the bank as a service model, or how do you see Varo?
I think the bank as a service piece, I guess as it's defined, yes, I mean, we're not consuming those services, but we have disaggregated it. So a bank as a service provider will provide you, debit card processing and a core system to keep track of all the balances, et cetera. and would connect you to a card fulfillment provider to deliver debit cards to people, et cetera. So in our old model with the sponsor bank, we had direct relationships and some were bundled. And now it's more like we've got all of those relationships directly, but we still outsource a number of parts of our value chain and connect to partners with the same API-based approach that we used when we were with a sponsor bank, with a banking as a service model, right? But clearly, like, banking as a service is evolving, right, as well, because and players are starting to bundle in the technology and the banking piece together, right, to help folks get started in this space.
And is that something that Varo is looking into, either using as a service on the client side, or do you see Varo being on sort of the vendor side of that coin?
I'd say we're focused on serving consumers, like end consumers, and so being a customer of those service providers.
Yeah.
So we didn't become our own bank so that we could then be a sponsor bank for other fintechs. We became our own bank to serve the customers, the everyday American customers that we're focusing on.
Yeah. Koki, wanted to get your take on a few things here as well. One of the aspects of this banking as a service trend is sort of the building of kind of networks and ecosystems. And I know that you've been looking a lot into this recently. I was just wondering if you could care to comment on what you're kind of seeing from a ecosystem perspective, and your thoughts on how players on sort of both sides of the aisle around that can benefit from that from this emerging ecosystem development.
Absolutely. That's a great question. And thanks for doing this, Ron. It's good to see you. I think I want to make a differentiation before I begin to answer that question. We've just ended, I would say early last year, we ended what I would call Fintech 1.0, which is to say that all the original fintechs that were solving those big problems that affected people in like a very fancy way. I like to use Venmo as the example, right? Like, they really simplified peer-to-peer payments and made them free. I don't fault them for adding a social feed, because when they launched, we were all addicted to Facebook. But it is very much representative of what Fintech 1.0 looked like, in my head at least. Fintech 2.0 is a little bit different, and I think this is why it's so exciting. Fintech 2.0 is literally all about partnerships with everybody specializing in their particular role. So I like to use Alloy as the example. Alloy is a KYC ID and V vendor. Basically, they're a single API touch point for all things onboarding, right? I kind of think every company is going to look a little bit like that. And I use the acronym WAS, whatever as a service. So whatever it is that they do, they'll do it as a service, and they'll partner to make up the gaps in their own product. So that is to say, if I'm a community bank and I'm looking for a little help on my onboarding side, yeah, I'll use Alloy for KYC and ID and V, but I'll probably use Hummingbird to do my transaction reporting and monitoring. So that's kind of how I think the pieces fit together. And I think we're going to see more and more of this. We see a lot of these middleware players coming out of the ether. We have Move and Unit and Rise and Wise. They've all made them 4-letter words just to make my life a little easier. So I'm super happy about that. But what's interesting about that is that they're not offering what banking as a service was 5-10 years ago, which was the bank in a box. What they're offering is connection to all sorts of existing partnerships that they've forged that the fintech customer can then leverage. So on the ecosystem side, I think we're going to see everyone getting a lot cozier.
Yeah, and I totally agree with you. And that's why I've been pushing for, and probably confusing even myself, when I think that we're kind of evolving from this banking as a service world to more of a fintech as a service world, where it isn't just sort of the rent a charter that it used to be, to a much more complex sort of offering. But as we move to this kind of more complex world, Andy, I think there's a lot of legal considerations and issues that especially a lot of financial institutions are kind of struggling and wrestling with. And I know you work with both the financial institutions and fintechs. Can you talk a little bit about some of the legal issues of getting into this space, and from either side of the coin that you want to talk to? financial institution or fintech?
Sure. Thanks, Ron. And it's great to participate and to see the turnout on what is a really interesting topic. I think from my perspective, really from sitting on both sides of the table for the technology company or for the financial institution, it's going to sound weird coming from the lawyer, but really one of the key lessons that I think I've distilled is just how critical the facts are as to what exactly the two parties are trying to accomplish, and how elusive they are is really a challenge. It's really a challenge sometimes to pin down, particularly when you're talking to somebody like me, who of course is not a technologist, right? But I have to serve that bridging function, into things like, from the banking perspective. And I come from a banking background, not the technology background. That's really what I mostly bring is the banking understanding. Things like third-party oversight and third-party relationship management requirements for banks. So, there are some good, one of the things I like to mention in these sorts of get-togethers is, I know everybody's reading all kinds of things. We're at another change of administration. There's, going to be some questions about the utility of reading rulemakings that are in process. But I do think there are some good things out there that can still give you a sense, because a bunch of these issues are driven by technology and consumer taste and other sorts of forces accelerated by COVID that are not really partisan, right? So there is, there's a rulemaking out there in the way the OCC describes, what's going on. They don't use the term banking as a service. Back to Dove's, very lucid explanation of what the term means. Bank regulators don't really use it. They have a notice of proposed rulemaking out there about what they call digital activities, and because that goes back to how the OCC has described, bank activity in this. And the ABA has a really good comment letter on that I would suggest folks take a look at. And to the facts point, that's what the ABA says. So you got to look through the technology to what the underlying activity is, and that's how you assess the risk. And I think this ties into what Kogi was talking about with the complexity and the complexity of the ecosystem, increasing specialization, and the participation of different players in these solutions. It really puts a premium on those contractual connections. And that's what, we spend a lot of time in terms of trying to structure, transactions and arrangements, and trying to understand, where the regulated activity begins and ends, to what degree that certain things have to stay in a bank, right? Certain things in most cases, the bank could do most of the activity that's involved in terms of a permissible financial activity. And then there are things, of course, that the fintech, can't do because it doesn't have the charter. So trying to understand where those things begin and end in a particular fast-moving, a project is particularly challenging. So those are some of the things that we see. I think some of the things you can do to sort of lean into that a little bit more. I continue to be even several years into this, and I have my own kind of ideas about what version we're on. Koki, would love to talk to you more about that. I kind of feel like we're in the Empire Strikes Back, which is maybe 5.0, but whatever, it's tomato kind of thing. But I think trying to separate, make sure that you really know what your own role is, and doing that deep dive into the dependencies as a technology player. If you want to be the banking as a service company, understanding what your dependencies are on others and really shoring up those contracts and making sure that you're thinking through from the bank perspective how they're going to want to look all the way through to the end for anything that touches on the product that's delivered if the bank is sophisticated. So I'll pause there, Ron, because lawyers, we could just go on and on.
No worries. And I've got more questions for you coming up too, but I wanted to ask Dove something. Dove's got an interesting background in this space, having been at Currency Cloud and then Green Dot and now Rails Bank, and helping Rails Bank come into the U.S. Dove, as you kind of look at the competitive space in the US from a banking as a service perspective, how do you kind of make sense of it? Because, we've talked about payments as a service, lending as a service, fintech as a service. I know that Rails Bank is, moving in with credit card as a service. How do you look at the competitive landscape? How do you make sense of that from a US perspective?
Yeah, so we look at it in terms of red oceans and blue oceans. So payments as a service is very much a red ocean. There's a lot of companies that are in there that can do payments via API. And you end up kind of deciding who you want to go with based on what's important to you. Are you a developer that wants maximum flexibility? Are you a business person that doesn't want to deal with coding? It really kind of depends on the core solution that you're looking for. And companies are making decisions based on cost and based on flexibility of the platform. Banking as a service kind of had, I think, 3 core players, of which Green Dot was one of them when I was in the industry. But since then, I think there's probably been another 10 added to the list of new companies that are entering the banking and the debit space. And there's still new up and coming companies that are kind of entering that market every single day. But in reality, the ones of significant size, so the enterprise tech companies and the major fintech companies, those guys have built their platforms for the most part and are typically not shifting to a different banking as a service platform. They're doing what Varo did and becoming their own bank at some point. So when we looked at, and Rails Bank, by the way, is a banking as a service platform that covers all the different spectrums: payments, banking, debit, ledgers, from a global perspective. So the company is based out of the UK with 210 customers and 3 million end users. We just bought Wirecard. So there's a lot of established kind of business there. But when we looked at how do we come to the US, the market didn't need another banking as a service debit card provider. What actually the realization was, everybody who has a debit card in market wants to do credit cards next. And I went through this kind of period of, well, why doesn't anyone do it? And the realization was that the gap between credit cards and debit cards is about 15 extra elements, really around compliance and risk and credit line management and capital markets and all these things that are 50 times more complex than you could ever do in sort of a debit card world, where you load funds, you can spend down to 0, and then you're done. So the other aha moment was, look, if we could actually build this, there's a massive market, because we know that everybody wants to move into embedded credit cards. So you have to really build out this team of folks that are experts in each area of that application and kind of bring it back into the middle. So to answer your question, when you think about banking as a service, it's to the customer, it's less about what does the platform do versus what do I want to build, right? So if you want to build a credit card, now you know these are the players that you can go to build a credit card. If you want to build a debit card, much larger pool. If you want to build a payments product, even larger pool. So I think first thing is decide what you want to build. Next is look at the top players. And then the third point is kind of figure out what's important to you. Do you want white label? Do you want API driven? Do you want to kind of build it yourself and kind of piece together the different elements? Or are you looking for something turnkey out of the box? So there's a lot of differentiation kind of between the platforms as you get into that realm.
Yeah, one thing I just want to follow up with you though on is that, you mentioned, so everybody wants to get into this, but it's not really everybody. Who's really the target market here? I mean, do you actually see, selling into banks? Because many banks have gotten out of the credit card market in the past 10 years and now realizing they need to get back in, and it's not easy for them to do so. Clearly there are some big players like an Uber and so forth, big platforms, but beyond the really large platforms, what's the target market for potential providers of a credit card?
So there's a few. When you talk about debit interchange is significantly lower than credit card interchange. So when you look at product companies that wanted to create compelling user experiences, the underlying economics of a credit card allows them to develop much richer offers that lets them do cashback or invest with stock back or kind of all these other things that companies want to do. So there's an appeal of credit card from that component. Then you also have these apps like the Wealthfronts and the Betterments and the M1s and the Stashes of the world that they're offering debit cards now. But for myself, I spend all my money on a credit card, right? And for a good percentage of the population, the credit card is their primary spend mechanism. So even if you offer a debit card, you're only going to capture the portion of the market that spends money on a debit card. And if you can actually start to offer a credit card, you actually open up the proportion of people that are going to use your product and the amount of spend that gets driven through it. So it's a really strategic move to become top of wallet.
So
The
should
next
we,
market,
oh,
sorry,
sorry.
go ahead.
I was gonna say, so given that, should we be looking at the buy now, pay later providers like Affirm and Afterpay and so forth? Are they really payment as a service companies, or do you see them as something different?
It's a great question. I wouldn't even consider them as a service. I think they have a super compelling value proposition to retailers in the new world of online buying, where I bought my Icon Pass this year using Affirm, because why wouldn't I pay $100 at a time? Cost me nothing. Same thing with a Peloton. Why wouldn't I pay $90 at a time instead of $3,000? So they've actually managed to create this system where people are more willing to buy high ticket items because they can pay for them over time at zero interest. And what's really happening in the background is the retailer is just selling at a discount, but you don't have to actually realize. So they give a portion of that, but they sell twice as many products. So I think Affirm and those guys, they're really kind of solving a need of how do we help retailers sell more products. I think credit cards are a little bit more interesting because you will use it on everything if you can make the offer compelling enough. It's not limited to a single product.
Yeah, but at some point you have to pay Affirm, and I know, Capital One has said we're not going to allow payments on our credit card anymore for that. So at some point, isn't there a traditional payment mechanism still coming into play in the buy now, pay later scheme?
Yeah, I mean, I've been paying down my ski pass, and I think there's a payment that kind of comes into that. I believe that the economics that happen is, let's say I buy a ski pass for $1,000, then Affirm pays Icon $900, and they give me an interest-free loan, but they really just made $100.
Right, but you've got to pay Affirm. So how do you pay Affirm?
I think I linked my bank account with
So
an
it's an ACH transaction.
Yep.
Good. Just as long as you didn't say I write a check, because then I'd be a little worried.
I don't even remember. It just kind of happens.
Good. Hey, Wesley, I want to get you back into the conversation. Sorry for keeping you out so long. From a Varo perspective, I would imagine, you're looking at, partnerships and things like that, ways of expanding the product set. How are you going about doing that? What are you looking at, and how are you doing it from a, technology integration perspective?
Well, we already, leverage a lot of partnerships, right? I think to Koki's point, especially like when we came into the market, and put this together in 2016, right? Like these things weren't all bundled together the way they are now, right? So we kind of assembled it all ourselves, and we have a range of different partners that we're leveraging. I think now as we look at the next phase of products that we're offering, we are trying to say, well, how can we achieve that goal with our own technology or with the partners we have versus adding on new partners, right? We're beginning to see there's a cost to having multiple partners. And so we're also realizing like there's certain, elements of the experience or the value chain that we might want to build ourselves and have some distinctive IP around that. So I think our calculus has changed a bit in sort of how we look at partners versus when we were in our early stages, where it just made sense to, find the different partners to get something to market.
And so, can you talk more about where you're going in the future around that? And what are you? I mean, most banks are dealing with a lot of technology integration issues. Have you been able to? How have you been able to deal with that or avoid that in your evolution?
I mean, we built an architecture from the beginning that was to link to outside parties through APIs, to have a data lake capability to kind of bring all the data in. So, I think we've built an architecture that makes it very easy for us to link to outside partners, both in terms of for API connections, but also to take all the data and then bring it together in one place. So it makes it pretty easy for us. Really now the question is just sort of where do we want to partner versus where we want to build something ourselves.
So, I probably should have asked this earlier on, because I don't know how familiar people are with Varo Bank in particular, but is there a particular segment of consumers that you're particularly focused on?
Yeah, we're focused on everyday Americans. So, you know, middle income, lower middle income. I mean, the reality is that most fintech challenger banks, the early adopters, tend to be lower income folks who are moving over from prepaid cards, right? And so we have plenty of those customers, but we've been, you know, we also have, you know, middle income customers who are attracted because we give early access to the paycheck. We don't charge monthly fees and things like that.
Yeah, one of the attractive aspects of this embedded banking perspective, and I really am beginning to dislike the term because embedded payments is very different than embedded lending, which is different than embedded insurance or other, you know, every type of embedded financial services is kind of different than the other one. But one of the attractive aspects of this broader embedded finance or embedded banking is, I think, really, you know, expanding distribution and acquisition opportunities. You know, really think of that as distribution channels. So how are you, you know, going about the customer acquisition perspective from an integration perspective? Do you see the platform integration as an opportunity to acquire new customers, or is this really more a traditional, you know, let's
No,
just
that's
go out and advertise, you know, and be like Chime and spend 60 million bucks a year on advertising?
Yeah, no, that's a great point, Ron. No, we are looking to form partnerships to that lead us to acquire customers, and we're looking to do, you know, integration, technical integration with those partners. You know, we're doing it in stages, but I think the eventual point will be to have our own API that people can connect with to then, you know, make it easy for somebody to sign up for a Varo account through their platform, right? So we have a range of partners whose services we promote to our customers in our app. And then many of them also promote us to their customers, right? An example would be Steady, which is an online marketplace for gig work. So a lot of our customers are looking for work and looking for gig work. So Steady's a great service to them. But Steady also says, hey, here's this great bank account with Varo. You should try that. So there's kind of a cross promotion and integration that happens there.
You know, I got to tell you, Wesley, that I do a lot of consumer research, and I'm going to be publishing something in the next couple of weeks that pretty much says, you know what, the new challenger bank are the traditional community banks and credit unions. They're the ones who need to challenge now. The challenger banks have, I wouldn't say won the game, but you know what I've seen in the consumer research I've done is that firms like yours and Chime, Aspiration now account for 11% of consumers' sort of primary accounts. The challenger banks have 17% of the share of the second accounts, and 35% of consumers have a second account, and even a higher percentage of the third accounts. But you know what I really think is kind of coming down the line here is a new set of challenger banks who are going to challenge the Chimes and Varos of the world with really highly specialized, you know, focus. I'm thinking of companies like Joust and so forth, who only, you know, focus on gig workers. But there's, you know, companies like Bank Boulevard out of Kansas City that's focused on Black and African American consumers. Aspiration itself focusing on environmentally conscious consumers. And I think, you know, they're kind of building out, you know, a set of services beyond just traditional banking services to, you know, really focus on that narrow niche. Do you see that as a threat to even your business model?
There certainly is a proliferation of, you know, a lot of different players focusing on different market niches. I think the question is scale, right? And so you need to have a certain amount of critical mass. You need to have a certain amount of scale to make the economics work, right? And so I guess the question will be, can these niche players acquire significant scale to have like a profitable business model as well as sort of a, you know, appropriate, you know, value as an organization, you know, versus those of us that are trying to appeal to broader sets of Americans with maybe a bit more of a broader value proposition, right?
Yeah, you know, keeping on this topic of sort of differentiation and specialization, Koki, there's a question that came in from Christina McDonald that I'd like to direct to you. And Christina asked that, you know, given how easy it is to launch neobanks on a bank as a service platform, what's going to be the real differentiator for future neobanks? And I know Wesley's saying, you know, scale, but what are your thoughts on how the neobanks and challenger banks are going to be able to differentiate going forward.
I'm a pretty firm believer that the neobanks we're starting to see emerge and the ones that will continue to emerge as this year and next will all focus on really specified market niches. You mentioned Boulevard, Daylight comes to mind as well. They're focused on niches that combine people by identity. And I think that's phase one, right? I wrote an article a while ago that said that the last phase of this will be like by hobby. So I made a reference to Stalemate Bank, a neobank I made up in my head for chess players. And I think that's probably where we're going to see the neobank play go. The other thing, and I hate to bring it up, but the other thing that's going to be the differentiator is whoever figures out unit economics beyond interchange, because that's getting really old. So whoever's next on that one sounds great. And I look forward to meeting you. You're a genius. But yeah, that's the kind of thing that I think is going to be the differentiator. But I am really excited to see how these niche players work because I think it leads naturally to a theory I've had for a while that the last stage of banking, kind of before we get to invisible banking, where everything just happens, is ultra customized banking. I often use this example that if I open my Chase app right now, it will offer me 10% off at Olive Garden, knowing full well, because they have all of my financial data, that I have never been to an Olive Garden. I look forward to the day where I open my Chase app and it offers me something I actually use, like 10% off at Sephora. I think that these niche players actually have this option to be able to really dig deep into these customers that they know extremely well and they're built to serve.
Well, so a couple of things. Number one, I don't think you're looking out far enough, because I think the ultimate end game is the Bank of Koki. I mean, that's kind of, where it's at, the Bank of Koki. And but to your point about the unit economics, I mean, I wouldn't necessarily say clearly there's a limit to the interchange, because that still may be somewhat off. But where should the financial institutions be focusing, and even the neobanks be focusing on from a unit economics perspective? What is the business model that's going to emerge correctly, or successfully?
It's a great question, and if I had an answer, I'd be very, very wealthy. But instead, I'll offer this. We've seen what not to do, right? The UK has been a wonderful model for how to build a neobank, right? Monzo, Starling, they are the best of the best in terms of they achieved scale well before the American neobanks were even kicking off. But we saw them all falter really hard during COVID, and no one can blame them for that. Nobody was going out, no one was spending money. But what they did in response to that, to not be able to rely on their interchange revenue, was start charging for premium services like, oh, pay 50 pounds a month and you get a metal card and travel insurance. Metal card is a status symbol that people need to see you use if that's the point of you getting it. And travel insurance during a pandemic doesn't seem like something I'm going to pay 50 pounds a month for. So these kinds of things we've seen not necessarily work. I'll toss this to Dov. I really think he's got it right. I think credit is really the thing that's going to be the differentiator. Credit's going to be the thing that can change the revenue models a lot of these neobanks really, really cleanly and really quickly. All they need is Rails Bank.
I think there's a bit of a challenge there, though, Koki, in that you've got a lot of the, even as Wesley says, a lot of the neobanks focusing on low to middle income consumers, where credit is going to be a tough thing. I'll tell you, I think there's a whole bunch of potential, non-interest income type of services that a lot of both neobanks, challenger banks, and traditional institutions could be offering. Things like subscription management services, things like bill negotiation services. I think even cryptocurrency investment, data breach protection services. And I got to tell you, the survey that I just conducted last month of financial services firms, it's depressing how few are planning to or even interested in providing these kinds of services. So I think the things are out there, but I think the part of the challenge for a lot of the large organizations is that their business model or their decision-making process for launching a new product or service is, if it doesn't have a huge ROI associated with it, it doesn't get run up the flagpole. and instead finding a much more nimble and agile way of launching a lot of services that not everybody goes for. They're all looking for the home run. I think, which I think is a kind of the challenge here.
Yeah.
And to your point about Monzo and Starling, I wouldn't necessarily lump them in the same group together, because Starling started with much more of a platform type of a service versus Monzo or anybody else. And I think that's one reason why Starling has been able to sustain its model versus some of the others. So
Sure.
yeah.
I think the other thing I would add is that obviously I like things that are very unsexy, which is why I'm an expert in banking infrastructure. But the other thing that I think will be really interesting is when insurance comes back into the fold. We've seen a lot of really interesting things happening in the insurtech space. When insurance plays start being incorporated into our neobank experience, if I could have an easier experience getting car insurance, take my money. I think that'll be really interesting as well to kind of spur along the economics of the neobank.
Yeah. Andy, I want to come back to you if I can. We're literally a week or so into a new administration, obviously going to see a lot of changes from a banking perspective, in particular from a regulatory perspective. I know the previous director of CFPB has already resigned, and I know they were looking at a couple of new things. What do you see kind of coming down the pike from a regulatory perspective, and how it's going to impact payments and this world of banking as a service?
So a couple things. I alluded to this when I spoke earlier, Ron. It's of course challenging to see to sort of discern what's going to end up being a partisan issue and what's not. I mean, on the one thing, there are two things I'll talk to. One is a sort of a framework to talk about this. We can talk about the Bureau's task force report that came out right at the end of the administration, and maybe handicap a little bit what might survive in terms of recommendations or actually find legs in the new administration. And before I do that, just one thing I'll throw out back to the third party relationship management issue that I find so challenging in these arrangements. There's also the FDIC has put out a request for information. They put that out in the summer on what they call standard setting and voluntary certification for models and third-party providers of technology and other services. That's a mouthful, but the basic idea is if you have a platform or a product or you're a provider, you could get a little bit of the good housekeeping seal of approval and from some public private partnership that certifies it, and that would enable you to satisfy a lot of this due diligence nonsense that is duplicative and unnecessary, in my humble opinion, in many cases, or it's certainly overcooked when it's overdone, when it's done over and over again. So turning to the task force report, it's a very thoughtful piece. It's 2 volumes of some 900 pages. And this is Ron getting at me and saying, look, Andy, you should interpret that, figure out what's in there for everyone, because nobody wants to read 900 pages of stuff. So I cheated. Of course, I didn't read all 900. I focused on volume 1 is only 800. Volume 2 is a real lightweight, only 100 pages. Volume 2 is the recommendations are distilled. So volume 1 is all about, a history of, consumer financial protection. And there's some fairly interesting stuff in there, including there's a dissection of behavioral economics, right? I mean, so there's lots of good content, but focusing on the things that, are in the form of recommendations. I zeroed in on 5. There are 16 in all in terms of sets of recommendations. And there are really 5 sets, I think, that bear on what we're talking about mostly today, about banking as a service and related types of issues. And the first one of those, the very first of the 16 issue areas, is what the Bureau calls alternative data. And they talk there about eliminating barriers to the use of payment and cash flow data. They talk about clarifying that the FCRA applies to data aggregators, which is a bit of a hot button issue, I know. They talk about the need to make sure that we don't unduly restrict the use of non-financial alternative data to when we're enforcing the fair lending laws, because that has a chilling effect potentially on availability of credit, pricing of credit. and also eliminating undue restrictions in the language of the report on the reporting of payment data, like for example, from communications providers. Any regular payment, of course, is useful for assessing someone who has someone who's a thin or no file consumer. So I would assess, in general, this constellation of issues all around data aggregation, and then the other as good, that the outlook is generally good, that there will be progress in this area. One reason I say it is not actually in the report, but there's a rulemaking, right? There's that the Bureau started in the summer to implement Section 1033, which is really the kernel of open banking for us, right? That is the piece of Dodd-Frank that says consumers have a right to their electronic records of their financial activity. So that rulemaking is going in parallel, and I think that there will be some progress in rationalizing the treatment of alternative data, somewhat along the lines of what you see in the recommendations. In the rulemaking, they allude to the Yodlee and the Plaid litigations. They allude to things like the potential for consumer confusion and what are really the appropriate ways to explain to consumers how their data is going to be used in these complex ecosystem plays. They really get into that in the task force recommendations. So that's one of the five. The second one I would call out is what the Bureau calls competition, which always lights my eye up, rise up, right, when I read that, because that's, so much, I think, what we are trying to, what we hope from a policy perspective is that regulation will have the effect of fostering responsible competition, right? And so they talk in the report about increasing the research capacity and studying competition. I don't really think there's going to be much appetite for that in the new Bureau. But they also talk about, again, they get to the core open banking concept of a bank account portability. That's a recommendation, or at least the study of bank account portability is in there. And I think that would be, obviously very, very favorable in terms of fostering competition if customers can take, just like their phone number, their bank account number to another institution. So I rated that one as good. And then there are a whole bunch of other, competition sort of concepts. Some of the more nonsensical ideas, not ideas, but concepts, and everybody knows they are. A $10 billion threshold is not particularly meaningful, right, in its own sense as a threshold for triggering Bureau supervision, for example. And that has a bunch of distortive effects, of course. It could have the effect, for example, of deterring an institution from growing that's actually doing well. Why would we deter that institution from growing across the $10 billion asset threshold? So I'm sure the drafters of Dodd-Frank were very aware that these were challenges, and they just had to set some framework. So I think there's a fair outlook for some of those things. Another sort of throwaway in my mind is they think that in the competition bucket, the Bureau should study the utility of state licensed lending laws. And, they point out that all of these disparate requirements for state licensing, in order to engage in consumer lending are not, they can't all be right? Because they all come at the issues from so many different ways in terms of disclosure. And so really, is that something that, ought to be continued? Not that the Bureau has the power to do anything about that, but they suggest that be studied. So I don't think that kind of thing is going to have much legs in the new administration so much.
Good. So David, we got just a little over 10 minutes left, and I see there's a bunch of questions that have come in from some of the folks who are dialed in. So I want to just make sure we can try to get to some of them. And Wesley, I want to direct one of them to you. Jen Byrne asks if you can share examples of successful partnerships. I know, Wesley, you mentioned that Varo is getting into partnerships. Talk a little bit about how you've structured these models, how you create win-win scenarios, how you kind of structure them to be successful for both sides of the coin.
Sure. So, I think this is still new for us, right? Really having, I think partners can be broadly defined. So would you like me to talk a bit about the example where we're working with other companies and kind of in a cross promotion framework?
Yeah, absolutely. And I think Jen's asking, how do you sort of create these things? I'll have to say that I think so much of what I hear happening in the space as partnerships are really just vendor-client relationships. You know how vendors always like to say, that their customers are partners. But I think Jen's kind of getting at more of a true type of partnership, where it's not a vendor relationship, and how you structure these things and, create them so that they're win-win.
I think that, we're looking for partners where the services they offer are, distinct and unique and innovative and appeal to our clients, right? And then at the same time, I think these same companies they say, okay, well, let me work with a bank, but like if I'm going to promote this bank to my clientele, then I gotta, sort of trust that their service is going to be, strong, that they're going to provide a good, banking solution to our customers. So we found a set of these companies, and we're continuing to work and build this out. We've tested a bunch of things in different categories to bring solutions around insurance, ways for people to earn money, extra money. That's really important right now, and people really are focused on those types of solutions. And then also where what we have to offer as a bank or fintech bank is appealing to that company's sort of other clients, right? So it's kind of a cross distribution relationship, and so we're compensating each other, right? So there's degrees where and it's also you want to base it on not just like in both sides of the business. Not, just because somebody is signed up to use your service doesn't mean they actually are using your service, right? So you want to focus it on the people who actually like engage and use the service, right? And so we will compensate based on people that become active, engaged customers, not just people that sign up for an account, and vice versa.
Great. Got another question I wanted to throw out there from one of the attendees, Dove, and I'll send this one over to you. I hope you'll be able to answer this. If not, feel free to pass it on, and I'll actually get Koki in on this one too. But Alex Jimenez asks, what's the role of crypto and DeFi, or decentralized finance, to the future of payments? Any thoughts on that, Dove?
So it's becoming more and more commonly accepted, which I think is impressive. It kind of started off as this counterculture, but you can obviously see there's a large demand for crypto as an investment asset class for the most part today. I don't think it's really expanded too much to the payment space. I think the world is actually, there's a lot of examples of companies that issued crypto debit cards only to find out that people didn't want to spend their crypto, because typically it's going up 40% a week. And obviously they're kind of investing that as an investment asset. But one of the things that we've explored recently, which I think is really interesting, is could you take your crypto and use it to secure a line of credit so that your money can stay invested, but you can still spend it as if it was cash? And I think as you kind of come up with more innovative business models around secured credit, where the assets can stay invested versus the traditional secured credit where you just have to park $200 in an account and nothing happens, you essentially like bring that secured credit model to the affluent masses and actually create high spend products that allow them, that really meet the needs of the customer.
Yeah, as you say that, I'm like thinking in my head, I'm going through my mental Rolodex thinking, do I know any bankers who would be willing to, secure a loan with crypto as the underlying asset? And nobody's coming to mind just yet, but an interesting proposition. You'd also, you have, PayPal, who's now come out and said, they're going to will offer a card that, basically in effect, pays the merchant in the currency, not crypto, and lets people, use that and gets them into that space. So I think there's some interesting hybrids there. What about the
point? I think that's it. But just to comment on that,
yeah,
I don't think you're ever going to find a bank that's going to be the lender who's going to buy that paper. But now there's such an interest in crypto. You have giant broker dealers that have massive balance sheets of crypto that they could potentially lend against and fund the assets.
Yeah.
So there's alternative models. There's also credit funds that are more than happy to have loans secured with crypto assets. So you don't just look to banks and all of a sudden your market really expands.
Oh, I thought you were saying like from the consumer, the borrower perspective, that the underlying asset would be their crypto.
Well, let me give you an example. Say you have a crypto wallet, right? And it's provided by a company like Coinbase. right? Coinbase could then offer a credit card at a 6% interest rate that you could use to buy a car. And they could do it at a 30% loan to value on the crypto assets that you hold in your portfolio. And they have this giant balance sheet of crypto that they could technically lend against. And in the event that your portfolio value of crypto drops by 20%, they have the right to sell your assets. But now you actually have a credit card that a much broader form of the population will use for large purchases and actually leave the balances on there.
Yeah.
Right? Why not?
So Suchitra, sorry, is asking, isn't that what Cred did? I'm not familiar with what they did. Are you?
I'm not, but it looks like Koki is. I see her nodding.
Yeah, so Koki, jump in here and please address that, as well as sort of the whole DeFi aspect of of Alex's question.
Sure. Yeah, so that is kind of what Cred did. Cred also offered it was like collateralized credit. Is that what they were doing? Like the credit card service? They did something like this. Their back end looks a little bit like this from what I understand, but I don't know their business all that well. And then on the DeFi side, like Dov, I'm also very interested in how we collateralize loans going forward. And one of the things I've been thinking about is, obviously from my perspective, I talk to a lot of early stage founders. And one of the things I notice a lot is that, and this is no surprise to anyone here, white male founders get funded a lot easier, underrepresented founders a lot harder, underrepresented founders from anywhere that's not San Francisco or New York City, even harder, right? But raising that amount of money, your pre-seed round is typically around $1 million to $3 million if you're lucky. That's what you're aiming for usually. That can be somewhat daunting if you're not in these networks, but the one thing that you can start to look at is some of these crypto projects are getting really interesting. There are DeFi projects that will collateralize a loan for businesses to get them off the ground. So you have all those staggering statistics, but it's very interesting to see what they might be able to do. So one of the things I've been looking at this week, I kind of went down a rabbit hole, but one of the things I've been looking at this week is how to filter people to crypto projects without them getting skeeved out. Obviously, we have entered the mainstream in a lot of ways. Everyone loves their Bitcoin and is sitting on their Coinbase refreshing all day. Trust me, I know, I do it. But I think the first point is that crypto investing is 1% of what we're going to do with crypto. And it's probably the least interesting thing we're going to do with it. The second thing I'd like to think about is how DeFi has restructured, first of all, how we can get loans, how we think about loans, and how we think about yield. Because a lot of these crypto projects can offer you a lot more. So that's kind of how I think about it. That's my somewhat educated opinion. Mildly educated opinion. I'm still not very good at crypto.
Good. Well, you know, I'm going to give the last word here to Brian Chin, who said, wow, collateralizing with crypto, imagine the margin calls. Yeah, you can imagine the margin calls. Well, listen, we are almost at the top of the hour. And on behalf of NYPAY, I want to thank Dov Marmer from Rails Bank, Andy Lorenz from Davis Wright, Tremaine, Wesley Wright from Varo Bank, and Koki from all of the various things that you are involved in there. And appreciate you guys taking some of your time out to share your thoughts on banking as a service and these trends that are going on with embedded finance and embedded payments. And I will not sure who I'm turning things back over to NYPAY, but just in case somebody there wants to make some closing remarks and tee up the next session, which I think actually kind of flows out nicely from this one, because if I'm not mistaken, it's about buy now, pay later, and some of the things going on there. So I don't know if somebody from the NYPAY side just wants to just sort of close us out here.
This is David True of NYPAY. I want to thank all those who attended. You blew the doors off both with the content and the attendees. We didn't anticipate so many. So for those who got closed out by our cap of attendees, I apologize. This will all be up on our YouTube channel within 48 hours. And Ron is absolutely correct. Our next event is going to be on point of sale finance, buy now, pay later, and the traditional credit card financing. And should the credit card companies be worried? Anyway, that will be on the 24th of February at 6 p.m. So check out our site. And I thank you very much for attending. I have massive thanks for the panelists and for Ron for making this such a wonderful and informative event. And I wish you all the best for this winter evening.
Thank you.
Thanks,
Bye.
Cheers,
everyone.
everybody.
Thank you,
Thanks,
Ron.
guys.
Thanks, everyone.
Thanks all. Take
everybody.
care.